Hi everyone, I'm Neha Singh, founder of Womoneysta and a certified financial planner. And today's session is titled Wealth, Work, and Womanhood. Investing as a mom, which is a part of Hera's return to work journey. For women who've just re entered the workplace, trying to prioritize all the different roles that you have could anyway be difficult. And add to that the fact that you need to also manage your financial responsibility. So, today in this program, we are going to find a step by step structure on how you can get started with making your money life, which is super important. But once it's structured, it'll be so much easier to manage as a mother. Why are we even talking about this? Why does this matter? Now, returning back to work after having a new human at home is no longer just about physical, emotional, and mental well being. There's also a financial aspect now added to our lives. Most women find it not very difficult to focus on savings, but investing and creating wealth is something which gets harder and harder, especially now when we are already stretched in different directions after motherhood. Data suggests that only 33% of working Indian women actually use tools like mutual funds to invest their money. In this particular section, I'm going to talk about two major things why this is important. The first one is now you are responsible for another human. You need to make sure that you have money on your side to do everything that you want to do for this child who's come into your life. And secondly, as a parent, a softer aspect to this is that whatever values, whatever actions you demonstrate with money will become a very core part of your child's money behavior. So, as a mother, if you're looking clueless or if you come across as someone who's always dependent on another person for creating wealth, that's the behavior you're subtly passing on. So it's time to become a little bit more self aware of what are our money values, what are our money actions, and how is that getting imbibed into our child's money mindset. As I promised, we are going to build a simple structure. And to start with our structure, with our money, we are going to start with something as simple but very important as goals. I want you to build out a simple goal sheet for yourself. What is it that you really dream? What are the things that you want for yourself and for your child and for your family in the future? Now, this could be something you want on a regular basis in the short term, something you want in the medium term, or something you're looking at from a long term perspective. Break each goal down by target amount, time horizon, and their purpose. So, if you are interested in creating a travel fund for every year travel or something which is focused more on their education, you're going to write that down, make a specific amount, put a time horizon to it, and that's how you're going to get a simple goal sheet. We're going to share a goal planning template as part of the resources with this program, and you can refer to that for any guidance. Before I start talking about different investment options and how to design our wealth portfolio, it's very important to identify how much risk am I comfortable taking. What differentiates one investor from the other is not how much return they can make. It's always the risk appetite, the risk capacity. And this is not something which is static. It changes with our life situations. It changes with our financial stability. It also changes when there is some new major change in our life, like motherhood. So I want you to first go back, go inwards, and identify your risk profile, your investment personality. You can log into several online risk profiling questionnaires. Some of the examples that I can give you around risk management would be, say, if an investment drops by 10%, how are you most likely to react, right? You're going to pull out your money, you're going to wait for some more time, or you're going to invest more because it looks cheaper right now. There are several such risk profiling questionnaires available online. You can look at it. It will help you identify what is your inherent risk nature, what is your existing understanding or knowledge of financial markets and overall of finances, which are creating that risk profile for you? What is it that you have in terms of liquidity or financial stability, which has been designing your risk profile? So, with that clarity, one can then take the next step towards building their investment portfolio. Just like any good recipe will have certain key ingredients, designing your investment and wealth portfolio also requires you to understand certain key financial ingredients. And I'm going to break down these heavy words which you might have heard before. Asset classes. Asset classes are nothing but different areas in which I can invest my money. Asset classes can broadly be divided into these three segments: debt, equity, and gold. Another asset class which you would have heard of, very popular for us Indians, is real estate, right? Debt is something which is uh, also called as fixed income, where basically I have some guarantee or assurance of a return and there is some maturity period attached to it. Can you think of one debt instrument that is very, very common and popular? Bank fixed deposits, something that has a fixed or assured interest and a certain time period. The second asset class in your wealth portfolio will be of equity. Equity is nothing but stocks, a part of being a part of a business, buying a small part of a business, that is being a stock investor. And the third one, which most of us know of, love dearly, is gold. How can gold be a part of your portfolio? Not just in the form of physical jewelry, but also in the form of certain financial gold or digital gold, where you can actually just invest and pull out that money whenever you require it. You don't have to consume it, you don't have to wear it, you don't have to touch it and feel it, right? So these are different asset classes, and a good portfolio will always have a balance. You know how we have a thali when we eat our food, which is a balanced meal? Similarly, always keep in mind that when you're designing your portfolio, it needs to have a little bit of debt and safety. It needs to have some equity to give it that wealth creation, and it needs to have gold to balance out anything which is going haywire or wrong in the economy. Gold is going to sustain that and it's going to create balance in your portfolio. While I really do recommend working with an expert, a financial guide, a financial advisor who's SEBI registered to help you create your first portfolio, here is a broad suggestion or a proposed allocation if you want to start doing it yourself. Please do consider this as a thumb rule. It might not be custom fit for you, but just to get an idea of how to get started, if you have a low risk profile and you're looking to meet certain short term goals, something which is less than 3 years away, do a higher allocation towards safe instruments or debt instruments. So your investments could be designed by putting whatever your monthly saving that you want to do, monthly investment you want to do, 70% should go towards safe investments like debt products, 10% should go towards something super aggressive like equity, and the remaining 20% can get allocated towards gold. If I have a medium risk taking profile, I am not very scared of being aggressive, and I'm looking to build wealth over the next 5 years, over the next 4 years, I could look at allocating my money 50% into safe instruments, debt, and the remaining 50% gets divided 35% into equity and 15% into gold. And finally, if you're someone who's aggressive, very comfortable with risk, something that you have been doing for a while, then and you're looking to build wealth in the long term, you have more than 7 years to look at it, there you can go aggressive. 70% of your investments can go towards equity, and the remaining 30% can get allocated to debt and gold, right? So these are just indications. Like I said, customize your exact allocation only by consulting an advisor. All right, let's deep dive a little bit into different types of investment products based on your risk appetite. Always remember, instead of getting lured by returns first, go inwards and work with what is the risk that you can take. If you're someone who can take a low risk, right? You don't want to be super aggressive, but at the same time, you do want to build wealth. I would suggest keeping your allocation majorly towards recurring deposits, post office schemes like PPF, National Savings Certificate. You can also look at working with short term debt mutual funds, which have not guaranteed returns, but lesser risk. So their ups and downs are very, very limited. If you're someone who is a medium risk taker, you don't want to have very high exposure to super aggressive instruments, then you can consider balanced or hybrid mutual funds. You can consider adding digital gold or even gold funds, or you can also do a mix of some amount going towards fixed products like recurring deposits, fixed deposits, and some amount going towards balanced and hybrid funds. And finally, if you're comfortable with taking risk, investments which are suitable for you, equity mutual funds. Within equity mutual funds, you can explore the world of index funds, large cap funds, flexi funds. There's a large world that you can explore. You can also consider building direct stock portfolios through instruments like small case or portfolio management services. And finally, you should be learning and exploring the world of ETFs. It's evolving where you can get exposure not only to Indian stocks but also international stocks, and you can get exposure to gold and silver as well. Let's talk about some numbers and the power of starting small. We all have heard of compounding, but today I'm going to show you visibly how compounding can work even if we start with small amounts. Let's say I can only put aside 6,000 rupees to plan for my child's education, which will be maybe 16 years later, right? Maybe she is 2 right now. I'm looking at having a corpus for her by the age of 18. So if I'm going to start investing 6,000 rupees over the next 16 years, and let's say I am looking at investing through mutual funds where I can get an annualized return of around 12%. What is it that my final amount could look like? I want to show you this through a demonstration of a simple calculator, the Womoneysta Power Calculator. You can use this. Let's say I'm earning, put 6,000, I'm going to earn 12%, and I do this for 16 years. This calculator shows you that the amount will be approximately 35 lakhs. Right. Now, let's say that you are not willing to take that much risk. The investments are going to earn, let's say, only 10%. What happens to my investment amount? How much I'm going to earn? Now, from 35 lakhs, I'll be able to put together around 28 lakhs. So, what I'm trying to show you here is that you can feed in the number that you're comfortable with only if you want to start with 2,000 rupees. What that could look like for you over a period of time, right? You can edit the value, you can edit the return, you can edit the time period. And this calculator we will share with you as a resource. So, make sure that you use it to start building wealth. All right, let's talk about how can your workplace support your wealth building journey. The first and most important thing is to become aware of all the benefits that you have from your company in terms of any stock options, in terms of NPS, gratuity, EPF, what are exactly the contributions which are being made, and how would your wealth look like today, and you can even take some estimations 5 years or 10 years from now. You can talk about any group insurance plans or any investment options which are being recommended by your company where you can get to participate in the same. Also, are there any financial wellness workshops that your organization has been conducting or any financial wellness online series which you can access, right? Take access to those, take benefit of those tools that you have. Finally, you can consider talking to them if there are any partnerships that they existing have with any banks, any mutual funds, any investment advisors. No harm in having a conversation. I wouldn't say leaning on them fully, but yes, exploring those options could be another way that you can get started with the wealth creation. Re entry into the workforce is also a great time to do re entry into your investing journey. And you can always use the PACE framework to get started. The PACE framework starts with P, which is planning for your goals. We've talked about that already. Aligning your risk appetite with the time period for your goals. We've talked about risk profiling. C is choosing the products. The way that you have different risk, you can choose your investment products, your investment allocation based on that. And the most important is to evolve and evaluate your plans on an annual basis. It's very important to keep pace because making a plan once is not enough. You've got to go back, check on it, and stay on the track as for what is your latest requirement. Right. In this journey, it's important also to continuously reflect and rebalance inwards. Money is not just about Excel sheets and the right investment products. It's a lot about our relationship, our values, and how we feel about money. So, what are some of the questions that I want you to go back over? What fears keep coming back to you when you're talking about wealth and investment? How can you take a small step to address one fear at a time? Don't get overwhelmed by them. Do you know where exactly your investments are parked currently? How much you have in cash? How much do you hold in the form of gold? How much you have in terms of financial assets like mutual funds, ETFs, stocks, so on, and insurance policies? Is there any one long term goal that you want to really prioritize and focus on? That's going to help you do away with the clutter of daily life, money challenges, and focus on that one thing that you really want to achieve. And finally, what will change for your child or for your next generation if today you take some bold investment decisions, creating intergenerational wealth? What do you think is going to change for your child or for your next generations if you take bold investment steps today? Creating intergenerational wealth can be super powerful. Seeing money not just for spending and enjoying, but also as a tool to create something larger. I want you to reflect and think about it, and then think what are the steps that you can take today to change the future of many, many generations to come. So, as I wrap up today's program, I want you to keep in mind certain key takeaways. Investing is just like any other skill, it needs time to develop, it needs some amount of action to learn from the mistakes. And once you keep practicing the skill, you start getting better at it. Creating goals for yourself, for your children is a great starting point because that's going to help you have a plan rather than creating a lot of stress, anxiety when you're closer to those goals. Always make sure that your portfolio is like a thali. It needs to have balance between different assets, some amount of safety, some amount of risk, and some amount of balance through gold. Finally, it's your duty to go and speak to your HR leaders about the benefits that you can experience today and the benefits available to your family. Finally, what I want to close this is that as women investors, it is a proven fact that we do better than our other gender. It's just that we need to find that boldness, the courage to start taking the first step. So, with this, I invite you to experience investing wealth creation as you enter this new phase of motherhood. Thank you for taking your time to go through this program. I truly believe that mothers not just shape their child's emotional, physical, and mental well being, they play a huge role in building the right financial mindset. And it really starts with you, not just focusing on the day to day expenses, but not just thinking about the small savings, but also having the power to think about wealth creation for yourself and for your child's future is totally in your hands. And with this simple structure of creating goals, creating a balanced portfolio, and starting small, keeping in mind that every great thing, every great habit, every good relationship takes its own time, and so will your money to compound and give you the right output. I hope with that knowledge today, with that simple message, you get started with just a small amount, whatever you can start with 500,000, 2,000, whatever it is. Start working towards creating your wealth as you start this new phase of your life. Thank you so much. I'm Neha Singh, your financial planner, your financial coach and guide, and I hope you enjoyed this series.